another episode of Traders TV. As many of you may already know, there's quite a few common chart patterns that a lot of traders use that have been around for literally centuries. In today's episode, we're going to concentrate on one of those chart patterns, which is called the flag pattern. Let's get started.
So there are two types of flag patterns. We have bullish flag patterns and bearish flag patterns. And these are the two commonly used ones amongst technical analysts of the financial markets. And essentially what we're looking for is a flag pattern where you have a flagpole, okay, and you have the flag which comes down in this type of retracement. And this is the kind of pattern we're looking for. The pattern suggests that when the market pushes higher and breaks through the upper end of the flag, then there's a higher possibility of the market continuing pushing higher as long as the trend is up. So that is a bullish flag pattern just drawn out using my little fancy drawing tool here. Now if we look at the chart behind us, the S&P 500, we can actually start to see a few of these patterns that have developed. So the first immediate one that we can identify is we have a flagpole here and we have the flag which has come down in this nice consolidation. Okay. Now, how you trade this will depend on you as a trader. If in this instance, if you traded it as it broke out, then it would have come down and most likely have stopped you out at a loss. If you waited for a close above the resistance level as a potential confirmation, then you may have been in this move to the upside. But again, with a trading pattern, all the pattern is suggesting is that if we do continue above the upper end of this resistance line of this flag, there's a higher possibility of the market going up. Of course, it's not a guarantee. Nothing is 100%. But as a trader, we're just trying to put the edge in our favor. Okay, but we never solely rely just on one tool. We use various chart patterns, indicators and things like that to help us give that edge. And first and foremost, we're always looking to risk manage because there's always a possibility we're going to be wrong on this trade and the fact that we're going to lose money. So risk management is really the key part to the whole trading process. But that's an example of a bullish flag pattern. You can start to see some other examples that have developed which look a little bit different, but we can see actually the flag has developed. Now you can see this one is a little bit more, this one, number one, is a bit more steeper than number two, okay? And sometimes that's going to happen. Not one pattern is going to be exactly the same each and every time. Every trade is going to be different. That's why some trades are going to be winners and some trades are going to be losers, okay? But you can start to identify these patterns as a potential continuation of a move back in line with the trend to the upside. Let's have a look at a bearish pattern example. So here we have the US dollar against the South African rand, and you may actually start to see the kind of upside down flag pattern where we have the flagpole here and we actually have a nice little consolidation in a phase 2 move, okay? And this is a flag pattern which suggests that if this level here breaks the lower support level, then we could see a continuation, or there's a higher possibility we could see a continuation to the downside. Of course, I've just scanned through looking for the best opportunities that I've seen historically. Because we don't always know what's going to happen next, we can never predict the future, okay? We never solely just rely on one technique. This just gives us a potential edge in the market. We want to combine it with other techniques to build up that picture. And first and foremost, we always want to make sure we risk manage, even to the downside, okay? As good as a trend may look to the downside, there's also a possibility at some point it's going to go back up. So it's always important to use stop losses and to risk manage sensibly. So there you have an example of a bullish flag pattern, a bearish flag pattern, and examples on how traders incorporate this into what they already do within their trading process. First and foremost, however, no pattern is 100% successful, so it's always important to risk manage your trades correctly.
So now you know a little bit more about the flag pattern, and you've seen where it can actually provide winning but also some losing opportunities. This is why a trading education is so important, so you understand both the good and the bad. If you want to learn a little bit more about Learn to Trade and who we are, then click on the link below. I'll see you on the next video.